All right, everybody. Well, we're moving into taxes, the wonderful world of taxes. So I've got the deck up, and there are 48 slides. Several of the slides in here, again, as you have access to these, are basically just examples of walking through how to calculate some of the some of the metrics, right? So tax liability, what your adjusted gross income might be. I'm going to leave those up to you, but as I go through the deck, I just want to kind of highlight some main thoughts to be thinking about as you're preparing for understanding taxes. And remember, this is not an accounting class. I'm not expecting you to be able to walk away and have a very detailed orientation of our tax system. It's obviously very complex. I do want you to have a basic understanding of how you can go about calculating your own tax return, what you might be looking for if you ever get into helping coach or counsel someone from a financial standpoint, what you might be looking for on their tax return, to help them, right? And there's ways and aspects of our tax code that allow us to um, legally reduce our tax liability. So we want to use all those to our advantage. So again, I'm just going to highlight various aspects of the content, and then as we go through, you'll see various slides with problems. I'm going to kind of leave those up to you for practice. Again, all of the answers should be there. I will say this, unfortunately, when we have concepts like taxes on a presentation slide like this, we need to make sure. Sometimes it can be challenging because tax rates change almost every year. Deductible amounts change every year. So it's very important that you are looking at a problem. And if the problem gives you numbers in 2022, make sure you're using those numbers. Okay. I tried to get all of these numbers updated to 2024. I may have missed something. So, just be aware that I'm not as concerned specifically as what the ultimate outcome number is. What I'm more concerned is you know the process, because if you know the process, then we can go and find what the table is for the very specific year you might be doing your taxes, or helping someone perhaps think through their taxes. It's not imperative that you know that in 2024 the standardized deduction is, let's say, 14,900. Well, that's going to change next year. In 2022, it was different. Okay, so just keep in mind that I'm more concerned about what you're able to do in terms of the process versus the specific numbers, because the numbers are going to constantly change. Okay, all right, let's go ahead and get started. So we pay tax on almost everything. Okay, if you want to try to minimize all the taxes that you have to pay, you almost have to truly stop living. Okay, you can stop paying the significant tax that most people have to pay for, which is this first one listed, which is income taxes, by stopping working. If you don't work, you're not going to pay an income tax. However, when you go to the grocery store, you're going to pay a sales tax. If you die with a specific amount of assets, you might have to pay an estate tax. If you sell something over a given value for a period of time, more than what you paid for it, you're going to have a capital gains tax. If you ever own property, there is property tax. Okay, depending on if you buy something like gasoline or cigarettes, you have an excise tax. Okay, there are taxes on everything. So we just want to make sure that you understand that your taxes obviously are going to pay for specific functions for society. Now, we may not always agree with what those functions are or uh, um, how they function, but we do need to take time to actually reflect on, like, we have paved roads, we have a police department, we have a fire department, we have a hospital, airports, we have tolls and bridges. We have those things obviously because of the tax base that we pay into. Okay, so obviously some hopefully basic or review items. The IRS is the departmental entity that oversees our federal tax system, right? The Internal Revenue Service. Taxes are determined over a calendar year, so from January 1 to December 31, and then they are due by April 15th of the following year. Now, there are some ways in which to get extensions, right? So where you can go from paying in April to in September or October. But typically your taxes are going to be due on April 15th. And there's a lot of different ways to file. There's been a surge of people moving to filing electronically. That's typically a faster way to file, but that doesn't have to be the way you do it. You can go and talk to an accountant. You can have a tax prepared service help you. You can go down to your local library and pull the tax forms and complete them by hand and mail them in. Again, depending on how fast you are wanting to process any type of tax return, um, tax return, depending on maybe if you're getting a refund and you like that refund sooner rather than later, you might want to file electronically. Okay, so do you need to file? If you generate income over a specified amount, and I believe it's the standard deduction, you are required to fill out a tax return. However, as you can see on the screen, there is a tax assistant that is located on the IRS government's website, which you can put in your information and it will determine whether or not a tax form, a tax return is required based on your circumstances. How you file depends on the type of return you are going to use. There are several different forms, but they're all traditionally what's called a 1040. A 1040 is going to be a personal tax return. Now, depending on your circumstances and what you have in terms of how much income you make, what type of deductions and tax credits you may be applying for, whether you are filing single or married or head of household. A lot of those circumstances will depend on the type of form that you will complete. So there are the 1040 Easy, the 1040A, and the 1040. And as you can see, there's various situations in which each one of those is going to apply. For many of you that are taking college courses and might have just like a part-time job, a 1040 Easy is probably going to be a pretty straightforward tax return that you could file if you are not already being claimed under your parents. Okay, so what about some of the taxes, right? So the first one is going to be FICA tax, okay? FICA is going to be paid into Social Security and Medicare, and it is part of the income taxes that you will pay. In addition to that, there is Medicare. Medicare is going to help cover health programs for those ages of 65. And these two together typically will make up your employment tax, okay? All right, so what are the breakdowns of FICA? So keep in mind, when you're employed, you will pay half of the FICA percentage or the tax, right? The percentage of your pay. The total amount is going to be 15.3%. Half of that is going to be 6.65, something like that. 6.5 of that is going to Social Security, and another 1.45 is going to that Medicare tax. Okay. And again, your employer pays half of that and you pay half of that. If you are self-employed, unfortunately, you have to pay the full amount. Okay. So just kind of keep that in mind if you want to have like a side hustle and turn into, into a job. There are a couple of different filing options. So if you are single, you would file single. If you are married, you could file married separately, or you could file married jointly. Those have different characteristics in terms of what types of deductions you may be eligible for. You also can, if you are a widow or widower, you could qualify under the qualified widow status. There is also head of household. Head of household, which is an individual with children. Okay. All right. So how do we now go about determining ultimately our tax base? Okay. So the first thing is we have to make sure we understand where all of the income is coming from that we have. We might work a full-time job. We might have interest and dividends that come from some of our investments. We might have rental property that might be passive income. We might have other investments that provide income. We might have a side hustle that might provide us an income. So we have a lot of different forms of income that we may be receiving. And so we need to make sure that we gather all of the documents that are going to help us know where all the income is coming from. But then we need to make sure we isolate the way in which we receive that income. So we could have active income, as you can see, could be wages, or if you're an actively participant in a business, if you own a business and you're receiving compensation for that. But then you can have passive income, and that could be things like rental income, or other investment income, and you could have portfolio income. Those are going to be interest and dividends from investments that you have. Okay, so there's a lot of different ways that income can be classified. On the 1040, one of the forms that may need to be completed is the Schedule B. And the Schedule B will just list all of the interest and dividends that you've received from various investments. And you will receive that information typically on a 1099. So you'll receive a 1099 from your bank, a 1099 from your broker, a 1099 from any other investments that you have. So those would be documented from the 1099 and then placed on the Schedule B for taxes. All right, so again, here's an example of what a dividend might look like. So we'll just kind of move on through some of these. Here's another example. What the dividend tax rate is. Okay, so another schedule that you have are capital gains and losses. So Schedule B is on dividends and interest that you receive. Schedule D is on capital gains and losses. And a capital gain is going to be determined by whether or not you bought or sold something at a higher or lower price than your original acquisition cost. So let's give you an example. If I buy a house at $100,000 and in 5 years I sell that for $150,000, well, then I sold it for more than I bought it. It's a capital asset, or I mean, it's a real asset, and therefore I would have a capital gain. And the flip side of that is if I sold it for $75,000 when I bought it for 100, now I have a capital loss, which means I sold it for less than my acquisition amount. So those transactions are going to occur on Schedule D. So we have a couple of examples here. We need to make sure that on capital gains, we actually have two different ways that capital gains can be determined. And they're going to be based on if it's short-term or if it's a long-term. And ideally, long-term is going to have a more favorable tax rate than short-term. Most short-term capital gains will be taxed at the higher tax rate of ordinary income versus long-term capital gains. And the dividing point is 12 months. So if you have an asset that you owned for less than 12 months and you sold it, then that capital gain or loss would be determined as a short-term capital gain. Likewise, if you have a capital asset and you sell it and you sold it longer than 12 months, then it would be determined based on the long-term capital gain and loss component. So we have a couple of examples here. So just make sure you go through those. Again, as you have questions on the examples, they're laid out pretty straightforward. It gives you all of the specific values, so you don't have to worry about understanding where the values are coming from. Again, let me know if you have a problem with any of these, and I'll be happy to walk you through those. All right, income sources. Again, we've already talked a little bit about this. There's a lot of different types of income. So as you can see here on the slide, we have wages, we have interest from our savings account or investments, dividends from stocks, capital gains, again, from selling assets, rental property, self-employment income, retirement distributions, even Social Security benefits. When you are receiving Social Security, that is a source of income. Okay. Income sources. Again, we want to make sure we understand what are the sources that are producing that income for you. Is it active income, passive income, portfolio income? And depending on the type of income, will determine the schedule that we use. Okay, so once we understand the gross income, now we need to make sure that we are adjusting that income given the IRS has given us some parameters that we can use to reduce that total income amount. And these are going to be typical adjustments that are going to get us to what's referred to as our adjusted gross income. Okay, so we gather all of our income and we get total gross income. And from that, we can reduce that amount by tax deductible contribution. So let's say you contribute to a traditional IRA and you put in $7,000 for 2024, your gross income is going to be reduced by that $7,000 amount contribution. Let's say you put money into a 401k or a 403b. That amount is going to be reduced or reduce your gross income. If you are an educator and you have paid out of pocket and not reimbursed for any type of educator expenses, those can actually be reducing your taxable or your gross income. And as you can see, there's other expenses here. These are just some of the common adjustments. This is not an exhaustive list, but these are just some of the most common. All right, so we give an example, and I'll just kind of walk through this one. Let's suppose that you have a salary of $75,000, interest income of $2,000, dividend income of $1,500, capital gains of $3,000, and you're wanting to try to calculate AGI. Okay, in this specific example, the IRA contribution and the student loan interest are adjustments to income. So we would add up all of those top 4 items, and then we would subtract out the IRA contribution and the student loan interest amount. Again, a couple of examples on AGI calculations. Again, make sure you go through these and you understand how they work, because these are understanding what your adjusted gross income is so important. There are so many factors that come back to whether you qualify for something based on your adjusted gross income. Okay, so understanding what that value is very important. Once we get to adjusted gross income, then we can move to the next way to subtract from this value, and that is determining the higher base between a standard deduction and an itemized deduction. So standard deduction is going to be what every individual can receive. In 2024, the standard deduction per person is $14,900. If you are married and you are filing together, the standard deduction, I believe, is $29,200. So an individual deduction or married filing jointly would have a standard deduction of $29,200. And the IRS basically says you should calculate both of these. Obviously, the standard deduction is given. There, you don't calculate anything. It's already provided to you. But you would then determine your itemized deductions, and you get to take the higher of the two, whichever one produces the greatest reduction of your income. So great for the IRS for giving us this option. If you are going to be doing your itemized deductions or selecting the itemized deductions, you will use Schedule A. So we've talked about Schedule B, we've talked about Schedule D, and here we're introducing Schedule A, and this is where you would list all of your itemized deductions. Okay, standard deduction, again, for 2024 is $14,600, and I said 900 earlier. I'm sorry, I believe it's 600. Or $29,200 for a married couple. Okay, and again, this is provided. There's nothing to calculate. You just determine if this is higher or lower than your itemized deductions. Then you would probably want to work with, if you have a lot of things that you believe are deductible from your taxes, you might want to talk with a enrolled agent, an EA, a CPA, an accountant, someone who is good and understands various deductions for taxes. But there are things that you can use to reduce your taxable income. So mortgage interest is an example. When you pay if you paid state income tax, that can be used as a deduction. Trying to think what else. Medical expenses can be a deduction. Again, there are certain rules and restrictions, but those can also be a deduction. Okay, here's a few more details. So property and medical expenses in excess of 7.5% of your adjusted gross income. So if your adjusted gross income is $100,000 and you had expenses over $7,500, which would be 7.5% of $100,000, then everything above that would be an eligible itemized expenses. Charitable contributions. You might have job losses or job expenses that are unreimbursed. Those could also be deducted from your AGI. Okay, so again, there's different ways that the IRS is giving us the ability to reduce our income. A couple of problems. Again, just go through those on your own. They're all pretty straightforward. So just make sure you're taking a look at those. Okay, taxable income calculation. So we start with gross income. We subtract out the adjustments that are provided, right? So that would be like IRA contributions, retirement contributions, student loan interest. Those would then get you to adjusted gross income. From adjusted gross income, we get to subtract the larger of or the greater of the standard or itemized deduction. And then we move on to our personal exemption, okay? And then from that, you come down to taxable income, okay? And the taxable income is what's going to be used to determine how much tax you ultimately pay. Okay, the US is in a progressive tax structure. So what does that mean? The more money you make, the more you're going to be taxed. And on this slide, you can see that we have 2023 filing for single individuals. If you make up to $11,000, you're going to be taxed at 10%. From the next dollar up to $44,725, that amount is going to be taxed at 12%. As you exceed $44,726 up to $95,375, you will be taxed at 22%. That amount is going to be taxed at 22%. So let me just give you an example. Let's suppose that you make $50,000. Let me just get my calculator here just so I have. So I'm going to do 50,000 minus 44,726. Okay, so that's 5,274. All right, so the first 11,000, I'm going to be taxed at 10%. The next $33,724 is going to be taxed at 12%. And then the next $5,274, remember, I made $50,000, so it's going to fall right after this, is going to be taxed at 22%, okay? So the more money you make, the more tax you're going to pay, okay? So this gives you a formula for how to determine that, and there's a couple of examples that follow. So as you can see here, we have the previous tax bracket plus 12% over this amount of money, okay? So remember, 9526, this was probably 2022 numbers, was the amount taxed up to 10%. So there's the 10%. And then we're taking 12% of the difference to this next tax bracket, okay? In this case, we would pay $2,809 in taxes. So once we determine what we owe in taxes, then we get to subtract out our credits. And credits are extremely valuable because they actually reduce your tax liability, not just a deduction from your income, but the actual amount that you owe for your taxes. And some of those listed are here. So a child credit, education credits, dependent care credits, earned income credits, adoption credits. There's also, there's education credits. Okay, good. Okay, and then the rest of this deck really just kind of talks through and goes through some examples between really how do I understand the difference between a tax credit and a tax deduction. A tax deduction reduces your income, which won't reduce your taxes as much as a tax credit in terms of how much you actually will need to pay the IRS for your tax liability, okay? And so again, it goes through a couple of examples using the tax credit versus the deduction. Here's a slide that talks a little bit about the different education credits. So an American Opportunity Credit, you can receive up to $2,500 per student. It's available for your first 4 years of post-secondary education, and you can receive up to $1,000 refundable to you, which means if this credit pays all of your taxes and you actually would receive a credit back, you could receive $1,000 of this back to you, okay? And then you have the lifetime learning credit. It's up to $2,000, but it is a non-refundable credit, which means you don't get actual dollars back if your credit is over the amount of your tax liability. All right, so we have just a couple more AGI calculation problems. So again, go through those, make sure you understand those. And again, here's the head of household. Here's what that would look like. Some high income, tax liability for marrying and filing jointly, and filing considerations. Again, we talked a little bit about this at the beginning. You can file by mail if you manually complete your 1040, which you can do. Because when you fill out your tax return, you don't actually have to send in all of your W-2s or your 1099s. You keep all of those records for yourself. Okay. Most cases, the IRS already has an electronic version of those documents that they can then use to compare what you entered on your tax return form. You can go and reach out to a tax specialist. Sometimes even the public library in your local area may actually have people who will help complete your tax returns for you. And then you, of course, can submit those. Okay, just keep in mind a couple of notes here. A lot of people get really excited when they do their taxes because they know they're going to get a really big refund. Now, that can be great, getting this massive check back, but I want you to keep in mind that every paycheck that you're putting money aside is money that is being sent to the IRS on your behalf, and you aren't receiving any interest on that money. So for an entire year, so let's say you get a check back for $6,000, which equates to $500 a month, and let's say that's $250 a paycheck. You have $250 of your paycheck going to the IRS, and they're going to do that for 12 months. And at the end of the year, let's say you don't owe any taxes, you're going to get this $6,000 check back. That's great, right? It feels good to get that big, large refund. However, you could have been investing that $250 into a savings account or an investment account, and that $250 over that years might actually be, if you don't spend it, might actually be much higher than $6,000. It could be maybe as high as $6,500. And you've lost the opportunity to gain that interest or dividend income. Now, I understand completely that sometimes putting money aside, out of sight, out of mind, and then getting a big chunk back can be extremely exciting. Although that's a bias, that's not actually in our best interest, right? There's a bias, just the mental accounting, how we think about money differently based on its source, right? So a lot of people think refunds can be a good thing, and you can make adjustments. You can actually go to the IRS website, and there's calculators on the IRS website that will allow you to put in your income, allow you to put in your dependents, put in some of your deductions, and it will tell you what you should be putting aside to cover what you're going to owe in taxes. Okay, so it's better to only send the IRS what is going to be required. We ideally, in an ideal world, you want to have a tax return that says you owe nothing. You don't get a full refund. You don't have a big tax bill to pay. You get zero. I mean, as close to zero as you can, because you then been putting money aside that you don't have to send to the IRS to for your own benefit into your own types of investments. Okay, so just keep all of that in mind. All right, again, as you go through these problems that are scattered throughout the PDFs, let me know if you have any questions. If you don't have, if you have any issues with those, again, I try to go through them. I think most of them are correct. Again, there may have been a typo. Some of the years values may be off, but again, if you have any questions, feel free to email me and let me know. All right, everybody. Hope this was helpful to get you feeling more comfortable about the U.S. tax system and how it's going to apply to you personally.